The other overriding domestic issue of the Obama presidency so far has been shoring up the economy and the nation's banks. Outrage over executive salaries and Wall Street bonuses has been reverberating all across the country ever since the recession began. Now, CBS News has learned that the Fed is planning some unprecedented steps to address the problem. And our business correspondent, Anthony Mason, is here with that story. Anthony?
Yeah, Katie, the Fed is just several weeks away from proposing sweeping new regulations on compensation for key bank employees across the country. The plan would affect not just executives, but also top traders and loan officers. The new rules would not set caps on salaries, but would force banks to abandon bonus plans that encourage the kind of excessive risk-taking that led to the global financial crisis. Already this year, the country's 5 biggest banks have set aside $60 billion to cover compensation, just $17 billion less than 2007. And that's after tens of thousands of layoffs in the financial sector. The French government recently imposed pay restrictions on its banking industry, and European leaders meeting before next week's G20 summit in Pittsburgh said excessive compensation must be at the top of the agenda.
We need to deliver on this. It's time to say enough is enough.
In the proposal the Fed's now discussing, the country's top 25 banks would have to present their compensation plans to Fed supervisors for approval. Compensation at the thousands of smaller banks would be reviewed as part of the regular examination cycle. Katie?
And ultimately, Anthony, how would the Fed actually force banks to discourage excessive risk-taking? How would that work?
Well, one way they could do it would be to force the banks to include what are called clawback provisions. That allows the bank to take back bonus pay years later in some cases from an employee who ultimately engages in risk-taking that proves to be a bad investment.
Interesting. All right, Anthony Mason, thank you.